Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Want to start making money in real estate but don't know where to begin? You're in the right place. In this episode of Real Estate Investing for Beginners, I'll show you the top tips to spot winning properties, avoid costly mistakes, and start building passive income fast. Let's turn your first investment dream into reality.
Welcome to this deep dive. Whether you are prepping to buy your very first rental property or sketching out a retirement plan, or honestly just insanely curious about how long-term wealth is actually built behind the scenes, you are in the exact right place. Today, we're giving you the ultimate cheat sheet on real estate.
Yeah, and we are looking at an absolute masterclass of a document today. It's a concise but incredibly dense guide titled Real Estate Investing for Beginners.pdf. What really makes this text so valuable is that it's built on over 40 years of practical business and financial intelligence.
40 years of data is massive. I mean, we are talking about lessons learned through inflation spikes, brutal recessions, massive credit booms, and technological revolutions. Our mission for this deep dive is pretty simple. We're stripping away the HGTV glamour, and we're stripping away the fear factor.
Exactly.
By the time we're done here, you are going to have a structured, real-world roadmap to real estate investing. No fluff, just the mechanics of how it actually works.
And to understand those mechanics, we really have to start with the foundational question of why. Why has real estate survived 4 decades of extreme economic roller coasters? It's certainly not because it's a fast process.
Right. Definitely not fast.
It has survived and consistently built wealth because it uniquely combines 5 key elements. You've got tangible value, income generation, leverage, inflation protection, and long-term appreciation. When paper assets completely lose their mind, a physical building that provides shelter still holds intrinsic, undeniable value.
Okay, let's unpack this. Because the text notes that real estate produces wealth through 4 simultaneous profit engines. And I love this concept because most investments only give you, 1 or 2 ways to win. If you buy a stock, you hope it goes up, and maybe you get a dividend. But real estate gives you 4 engines running at the exact same time.
It is a beautifully engineered system. So the first engine is cash flow. Very simply put, this is your rental income minus all of your expenses. It is the tangible money that actually goes into your pocket every single month. The second engine is appreciation. Over the long term, the property's value tends to increase, steadily building your overall net worth.
And then the third engine is loan amortization. This is the reality that month after month, your tenants are essentially paying down your mortgage for you. You borrow the money to buy the asset, but someone else is buying the asset for you brick by brick through their rent payments.
It really is magic when you think about it. And the fourth engine is tax advantages. Depending on your country, things like depreciation and expense deductions can significantly shield your rental income from taxes.
Okay, hold on. I need to stop you at depreciation because that concept trips a lot of people up. Can you break that down? Are you saying the government lets you write off the wear and tear of the building against the cash you're putting in your pocket?
That is essentially exactly how it works. Imagine the tax code recognizing that a physical building gets older every year. The roof ages, the foundation settles. The government allows you to claim a portion of the building's value as a loss on your taxes every single year due to that aging process.
Even if the property is going up in value?
Yes. It is a phantom paper loss. You didn't actually spend that money out of your pocket this year, and the property's market value might actually be skyrocketing. But on paper, you get to deduct that depreciation from your rental income, which drastically lowers the taxes you owe. Very few asset classes in the world combine cash flow, appreciation, loan paydown, and tax shields all at once.
That is wild. But before you run out and buy a strip mall to get those tax shields, we need to map out the playground. Understanding the categories of real estate is how you prevent massive rookie mistakes. We've got 3 main tiers to look at, starting with Tier 1, which is residential.
Right. Residential includes single-family homes, duplexes, and small apartment buildings. This is absolutely the best place for beginners. The financing is much easier to secure, the property management is generally simpler, and the demand is incredibly stable. People will always need a place to live, regardless of what the broader economy is doing.
Then you step up to Tier 2, which is commercial real estate. We're talking office buildings, retail plazas, massive warehouses. The income potential here is much higher, but so is the complexity. Commercial properties are highly sensitive to economic downturns.
Very sensitive.
Yeah, if a business goes bankrupt, that retail space might sit empty for 2 years. So this is generally completely off limits for someone just starting out.
And then we have Tier 3, which are REITs, or real estate investment trusts. These are publicly traded real estate companies. REITs are perfect if you are a beginner with very small capital, or if you want a completely passive experience. You buy them exactly like stocks, you get liquidity, and you have absolutely zero property management responsibilities. You literally just collect the dividends.
Here's where it gets really interesting, though. Even if you choose the perfect beginner tier, say a nice single-family home, there's a massive trap waiting for you. The biggest beginner mistake of all is emotional buying. I'm talking about walking into an open house, seeing a beautiful farmhouse sink, loving the trendy neighborhood, getting a good feeling in your gut, and deciding to make an over-asking offer.
Oh, it happens all the time. A great rule of thumb for beginners is this. If you would personally love to live in the house, you are probably paying too much for the aesthetics. Real estate is a business decision. You want a property that is boring, durable, and mathematically sound.
Boring is profitable.
Exactly. You buy numbers, you do not buy emotions. If you fall in love with the exposed brick wall, you have already lost the negotiation.
Which brings up the golden rule of the entire framework, cash flow first. You do not buy a property hoping the value goes up someday. You buy it for the cash it produces today.
Yeah.
But figuring out that cash flow requires some brutal stress testing. Let's run a real-world scenario. Let's say I find a cute duplex. I can get $1,000 a month in rent. My mortgage payment's only $600. I'm up $400 a month in pure profit, right?
Not even close. That $400 is a total mirage. To stress test those numbers, you must ruthlessly subtract the hidden costs. Yes, you pay the $600 mortgage, but you also have to subtract property taxes. You subtract the landlord insurance policy.
Which isn't cheap.
No, it isn't. Then you must budget 5 to 10% of the rent for maintenance because the water heater will eventually explode. You must budget another 5 to 10% for a vacancy allowance because the property will sit empty between tenants while you paint it. And you must subtract management fees, usually 8 to 12% if you aren't fixing toilets yourself.
So by the time I take out taxes, insurance, maintenance, vacancy, and management, my $400 profit might actually be $50.
Or it might be negative $50. If your profit margin on a spreadsheet is $50 a month, you don't have a business. You have a massive liability waiting to happen. The warning here is brutally clear. If the numbers barely work on a perfect paper spreadsheet, they will definitively fail in reality. Reality is where trees fall on roofs.
Let's talk about the tool that makes all of this possible, but also makes it incredibly dangerous. Leverage. Real estate allows ordinary people to control massive assets using borrowed money. You don't need $100,000 in cash to buy a $100,000 house.
Let's walk through the specific math example provided in the text to really illustrate this. Imagine you put $20,000 down on a $100,000 property. You borrow the other $80,000 from the bank. Now let's say the property value increases by just 10%. The house is now worth $110,000.
So you just made a $10,000 gain.
Right. But remember, you only invested $20,000 of your own cash. That $10,000 gain represents a 50% return on your actual invested capital.
Wait, I need to look at the other side of that coin. Let's revisit the scenario. I put in my life savings of 20 grand. The market boops and drops 10%. The house is worth 90,000, but I still owe the bank 80,000. My $20,000 equity just got cut in half to 10,000. I've effectively lost 50% of my capital from a tiny 10% market dip. How do you even sleep at night with that kind of magnified risk?
That is the double-edged sword of leverage. It identically magnifies your losses. You sleep at night by mitigating that risk through the oldest cliche in the book, location. Location dictates your rental demand, the quality of your tenants, and your ultimate liquidity, meaning how fast you can sell it if things go south.
But what makes a good location? We aren't just looking for cute tree-lined streets, right?
Correct. You are specifically looking for employment hubs. You are looking for infrastructure growth. Are they building new hospitals, new tech centers, or expanding highways? You want steady population growth, strong school districts, and good transportation access.
And the flip side of that.
You must actively avoid declining areas. Unless you are a highly experienced, hardened investor who knows how to do deep turnaround projects, declining neighborhoods will trap your capital. You won't find good tenants, and you won't be able to sell.
So what does this all mean for your bank account? You found a good location, the math works, now you need the money. Financing has its own language, and there are a few key terms you absolutely have to know to survive. We're talking about fixed versus variable interest rates. Fixed locks in your monthly cost for decades, while variable moves with the broader market, which can be terrifying. You also need to know your loan-to-value ratio, or LTV, and your debt-to-income ratio, or DTI.
Let's clarify those, because banks obsess over them. LTV, loan to value, is simply the loan amount divided by the property's appraised value. If you owe $80,000 on a $100,000 house, your LTV is 80%. Banks care because if you default, they need to know they can sell the house and get their money back.
Makes sense. And debt to income.
DTI, debt to income, is your total monthly debt payments divided by your gross monthly income. This shows the bank if you actually have the personal cash flow to survive a bad month.
And there is a massive red flag to watch out for when dealing with bank approvals.
Yeah.
If the bank says you are approved for a $500,000 loan, that does not mean you should take a $500,000 loan.
Never. Never stretch your finances to your maximum approval limit. Banks approve loans based on their internal risk models and statistical probabilities across thousands of borrowers. They do not approve loans based on your personal lifestyle comfort. If you max out your approval, you will be house poor. You will be incredibly vulnerable to the slightest financial shock.
And keeping that personal financial cushion intact is going to be a lifesaver when the inevitable happens. You're trying to eat dinner and your phone buzzes. A pipe just burst at the rental property and water is pouring through a ceiling. You basically have two choices for property management. Choice one is you self-manage. This absolutely saves you money, but it costs you heavy time and significant stress. You're the one driving over with a wrench.
Or a mop.
Or a mop. Choice two is you hire a property manager. This saves you a ton of stress, but it eats right into your profit margins every single month.
It really comes down to your personal capacity. But regardless of who manages the property, there are hidden costs that beginners constantly ignore. A property manager doesn't pay for the repairs, they just organize them. You are still paying for major plumbing issues, a complete roof replacement.
Oh man, roof replacements are brutal.
The legal fees and lost rent associated with evictions, the cost of tenant turnover cleaning, painting, and marketing the property between renters, and sudden, steep increases in property taxes and insurance premiums. Always assume your costs will be higher than expected. Conservative assumptions are the shield that protects your capital.
We really have to talk about the modern elephant in the room regarding property management, the short-term rental craze. Everyone wants to buy a cabin and run a boutique Airbnb.
Short-term rentals offer a much higher gross income potential. That is an undeniable fact. But that income comes with intense volatility. You face severe regulatory risks. City councils can and do literally ban short-term rentals overnight, entirely ruining your business model.
We've seen that happen in so many cities lately.
Everywhere. And the management effort is exceptionally high. You are not a landlord anymore. You are running a decentralized hotel. You are dealing with daily cleaning schedules, constant guest messaging, and highly variable seasonal demand. Beginners should master the stable, predictable, lower-risk world of long-term rentals first before attempting short-term hospitality.
It's a completely different business.
It is. If we connect this to the bigger picture, you have to understand that real estate moves in deep structural market cycles. We go through expansion, we hit a peak, we enter a correction, and eventually we go into recovery. Unlike the stock market, which can crash and recover in a matter of months, real estate moves incredibly slowly. A downturn in real estate can last for years.
Decades sometimes.
Exactly. This is why you must buy for long-term holding power. If you are forced to sell during a multi-year correction because your cash flow is negative and you can't afford the mortgage, you lose the game.
It's a great point to compare asset classes. When we look at stocks, crypto, and real estate, they serve very different purposes. Stocks are highly liquid. You can click a button on your phone and sell them instantly, and it's very easy to diversify. Crypto is highly volatile and has absolutely no intrinsic income. It doesn't pay you a dividend or rent just for holding it. Real estate is tangible, it's leverage-enabled, but it is highly illiquid. You can't sell a house in 3 seconds to cover an emergency. Real estate sits perfectly right between active business ownership and passive investing.
And because it sits in that messy middle ground, you need a highly structured approach to enter the market safely. The Source provides a fantastic 6-step action plan for beginners to follow.
Let's really dig into these steps. Step 1, build an emergency fund. Do not invest your last dollar into a down payment. You need personal reserves before you take on structural debt. Step 2, Improve your personal credit profile so you get the best possible financing terms. A high interest rate will absolutely murder your cash flow.
It'll wipe out that $50 profit instantly.
Absolutely.
Yeah.
Step 3. Study your local rental market obsessively. You should know what a 2-bedroom apartment rents for in your sleep.
And step 4 is where the real work happens. Analyze 20 or more deals before buying one.
Why 20? That sounds exhausting. Most people look at 3 houses on Zillow and pick their favorite.
Because looking at Zillow pictures isn't analyzing a deal. Analyzing a deal means running the ruthless stress test math we talked about earlier. You take 20 properties, figure out the realistic rent, subtract the taxes, the insurance, the vacancy buffers, the maintenance buffers. You do this 20 times so you develop a baseline for what a good deal actually looks like in your specific market.
So you train your brain to see the matrix.
Yes. By the 20th property, you will instantly recognize a bad deal and you won't be tempted by a farmhouse sink.
That makes perfect sense. Which leads to step 5, buy below market value whenever possible. You make your profit when you buy, not when you sell. If you overpay on day 1, you will spend a decade just trying to break even. And finally, step 6, maintain 3 to 6 months of cash reserves specifically for the property. This is separate from your personal emergency fund. This is the property's survival fund for when the roof inevitably leaks.
That intense preparation reduces your risk dramatically. And once you take that action and buy that first property, you enter the 4 stages of portfolio growth. Stage 1 is simply getting one well-performing rental. That's it, just one.
Keep it simple.
Right. Stage 2 is stabilizing that cash flow. This is where you learn the ropes of being a landlord. You build your network of plumbers and electricians.
I imagine the psychological hurdle between stage 1 and stage 2 is huge. Going from 0 properties to 1 is terrifying. But going from 1 property to 2 properties requires you to trust the system you just built.
Exactly. Which brings us to stage 3, using the equity built up in that first property to carefully expand and buy the next one. You let the first property fund the acquisition of the second. And finally, stage 4 is diversifying across different geographic locations, so a localized economic slump like a major factory closing in one town doesn't wipe out your entire portfolio.
But there is a massive warning attached to this growth plan. Aggressive overexpansion destroys many investors. Trying to jump from 1 property to 10 properties in a single year is how you end up over-leveraged, overwhelmed, and bankrupt. You scale when the math allows it, not when your ego demands it.
This leads perfectly into the 40-year conclusion of the data. After watching decades of booms and busts, the undeniable truth is that real estate is not a get-rich-quick scheme. It actively punishes overleverage. It punishes emotional buying. It relentlessly punishes people who underestimate maintenance costs.
But it generously rewards discipline. It rewards conservative planning, a laser focus on cash flow, and deep risk awareness. Structure is what builds wealth, not excitement. Excitement gets you into a terrible mortgage on a property you can't afford to fix.
What's fascinating here is the sheer power of the patience factor. The investors who ultimately win are the ones who stay consistent. They buy carefully, and then they let loan amortization and gradual rent increases do their quiet work over the decades. They don't chase fast, speculative appreciation. They let time and mathematics do the heavy lifting while they sleep.
And that brings us to the end of our roadmap. But before you go out and start running the math on 20 duplexes in your area, we want to leave you with a final thought to mull over. We mentioned earlier that real estate sits right between active business ownership and passive investing.
That's a hybrid.
Exactly. So you have to look inward and ask yourself a very honest question. Are you mentally preparing to run a localized, gritty small business? Because that involves handling tenant complaints, managing contractors, and balancing a tight budget. Or are you secretly just looking for a completely passive place to park your cash? Because if you treat physical real estate like a hands-off stock portfolio, those hidden costs and market cycles might just eat you alive.
This raises an important point about self-awareness. Knowing your own temperament, knowing your own threshold for a 2 a.m. phone call about a broken heater is just as critical as knowing the cash flow formula.
Thank you for joining us on this deep dive today. You now have the playbook, the math, and the mindset to look at real estate entirely differently. Keep learning, stay curious, and we will catch you on the next deep dive.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.